Hi guys, and welcome back to another video. We have officially moved into a new series. We are now moving into supply and demand, and this is episode 1 of supply and demand. In this episode, moreover, in this series, we're going to be going over what is supply and demand, how do we use supply and demand, what is mitigated, what is unmitigated, what is change of character, what is control, and what makes a good quality level of supply and demand. And then added in is also going to be supply and demand ranges. So there's a lot to go over. Let's get started. Let's start with what is supply and demand? Well, supply and demand is just a fancy word essentially for buying and selling, buying and selling, buying and selling. When you see price increasing, there are buy orders entering into the market. Those buy orders are demand for the currency pair that we are trading. There's demand for euro. Then there's sell. Then there's an over excessive supply of the euro. Then there's a demand for the euro. Then there's a supply of the euro. Then there's a demand. Then there's supply. So essentially it's just fancy words for buying and selling. But the reason we use supply and demand zones is because essentially we come from the understanding that certain levels of price, ones that have a sell to buy or buy to sell model that then have large volume backed behind them, are initiations from the banks and financial institutions that have initiated price to go into their direction, and as a result they need to bring price back to continue the level of price, the direction of price, sorry, to where they want it to go. So let me really explain this to you, right? When looking at demand levels, we're just looking at a sell to buy. The sell usually will take out a level of liquidity. That makes a very good zone. And then the buy has a large volume coming after it, right? Because if banks want to take price higher, they'll come back because these sells, they've initiated these sells. So they'll bring price back to close these sells at break even before continuing price in alignment with the order flow. And the exact same is true for supply zones. Supply zones, we want to look for buys to sell. And then we use the actual buy to sell itself, because the buy is what needs to be brought back to mitigate out a no win, no loss for the banks. Because usually that buy will have taken out a level of liquidity, mitigated and continued in order flow. Very simple. Hope you guys do understand. You can go ahead and check out the PDF if you don't. Now let's really explain what they look like, right? So they come in all shapes and sizes. There is no absolute definition. It's more about logic. So, of course there is definition, but it's more about logic than anything else. So, in one example, let's give you two examples, or three. Let's see. Let's bar replay. The first example is this overall demand range, not just one candle, it's a demand range here, right? The sold to buy, sold to buy. Okay, so that means there was probably pending orders left inside of here. Now there's a lot of people in this industry that would just use this one candle and get wicked out and then be like, no, really the sell, the big sell comes from the wick of this blue candle when it sweeps below this level and takes a level of liquidity. Liquidity will go into in the next series. It's very simple to understand. And when it does so, what do you expect? More than likely, this high will be taken. Why? Because they've sold to buy. They want to continue buying. So the sells, they've come back to mitigate before the continuation of price. Now here's another one, right? Let's remove the Asia session range. a sell to buy. The buy is engulfed. What does the sell do? It takes a level of liquidity. Sweeps. It sweeps a level of liquidity, sells to buy. That is an area of demand. They have the same principle, right? They both sold to buy. Then gets mitigated, and then goes. Now here's a different one. In this instance, we tap in and we buy again, and then we sweep, right? So the thesis of the sweep always stays the same, of the actual sell to buy for the reason of the liquidity sweep. That's what makes a high probable zone. This wick right here is a sell to buy. The sell comes from the wick, finishes up here, so it sells, then buys, and then we rally on. And if we actually take the wick in of itself, you can see we very barely tap him. Let's continue price. And then we break structure. This level more than likely still has orders inside of it. Okay, now what do we see? We're building levels of liquidity before the POI, point of interest, being a level of demand or supply that we're looking to take trades out of. And then you can see the tap in and then the reaction out of it, which produces then a new zone. Now, I'm not just using this candle because this candle doesn't do anything. This candle doesn't take out any levels of liquidity, doesn't sell to buy. So I would be looking more at the sell candle, the gray to buy, right? And this is a little bit different from a lot of other smart money people in the industry and whatnot, because we are using more of the logic than just a set criteria of candle, because at the end of the day, it's the logic that actually is important. Now, we hit create equal highs right here. We don't actually break the high. I mean, we may. Yep, then we do. Levels of liquidity. And then I think essentially this zone doesn't hold anyway because the narrative shifts, right? And then we sell off because we are continuing what? With the order flow. Because we've done what? We've come inside of a buy to sell supply range. This buy to sell is a supply range. A lot of traders will just take the one candle, and I also a lot of the time will use a candle if it makes sense, like one candle here, one candle here, two candles but on an 8 hour one candle. It's like you want to make it as small as possible, because the more refined, especially on the 4 hour, on the 15 minute there's a bit more leeway, but on the 4 hour you'll see a lot of the times price does end up coming back to a specific candle for a specific purpose. But this overall doesn't defeat the object. It's a buy to sell that breaks something, it comes back into the range and then shifts order flow. And so we didn't really do any levels of supply, essentially. We come, we create some levels of liquidity. Again, right, here's something interesting. Just ignore all this. This here, right? The buy to sell candle itself, and then the buy to sell range in of itself. They're both areas of supply. If you get what you need to get inside of the range in of itself, then you take it again, same here, buy to sell. These levels don't really take levels of liquidity, but they do break something, which is why we have it marked up. This one doesn't really do anything, to be honest. Still could produce some reaction, the same like this. Again, you can see, right, they do vary slightly, but overall they are the same, and the principle is the same, and the principle stays the same. Essentially, they are buy to sells or sell to buys that have large volume income into them, and then price returns back to them to mitigate or collect more orders, and then continue. Now, let's go ahead and discuss what is mitigated versus unmitigated. Now you understand why supply and demand levels work and why we use them, what they look like, and how to spot them. Now we need to understand how to know when you can use them. So we use only levels of unmitigated supply and demand to take entries from. Unmitigated is where price hasn't yet returned back to that level, right? So an example of an unmitigated zone would be this one, right? We have a buy to sell range. Let's push price down. Price hasn't yet come back to it. Let me give you an example right now. Sell to buy. Here's the zone. Right now, this zone is unmitigated. Why? Because price hasn't gone back to the zone yet. The minute price gets to the zone, not even including this, just the minute it gets there, it becomes mitigated, which essentially means the banks have had the chance to do what they're doing in that zone, whether closing orders, collecting more orders, or they're going to take price straight through it. The point is, when price revisits an area of unmitigated supply or demand, then it becomes mitigated. And it's unmitigated until price comes into it, right? Right now it's unmitigated, then it's mitigated. And now we have a new unmitigated one. And now it's mitigated once price comes back into it. So how does this look on the charts? Let's see, right? This level of supply is unmitigated. So you can take a trade out of it. And now it's mitigated. So you can't take a trade out of it unless you was already in it. This level of, I think I've already played it too far, no. This level of supply, buy to sell, that induce the liquidity out of these equal highs, is unmitigated. Now it becomes mitigated. Even though price went through the level, it still is mitigated. The moment that this candle touches it, it becomes mitigated, right? And then it blows through. And then we have this, right? Now there's a new level of supply, especially one that took liquidity. Now I want to show you why I use the wick here, because the wick is the buy to sell that took the liquidity out of the highs, out of these highs. So I would personally use the wick instead of the whole zone, and I would use that as an area of supply, which then gets mitigated and then melts off, right? And then this here becomes an area of unmitigated supply, and then this here is an unmitigated supply range. So the difference between a supply zone and a supply range is that a range is an area, can be multiple zones, of where the buying came in to then sell out. A zone is a specific candle or two candles, right? Very simple. I mean, you guys should understand that right now, right? This is a level of demand that was unmitigated right here. But if you were to use the actual range in of itself, the actual sell-in to the buy, the range has now been mitigated. But again, A lot of the times we do use the single candle, especially on the higher time frames. The moment that it gets tapped in, like that, it becomes mitigated. Right? It's very easy to understand. This is unmitigated. The moment it taps it, it is now mitigated. And I can show you the same thing 1,000 different times, but the point is if price has revisited the level, then it's mitigated. If price hasn't revisited the level, then it's unmitigated. This is a demand range, right? Price sells to buy. Becomes mitigated here. Gets mitigated again. Continues, right? Unmitigated. Mitigated. You can say the same thing over and over again, but essentially that is it. That is why we use supply and demand, what supply and demand is, how to know mitigated versus unmitigated, and that is everything for this episode. I'll see you in the next episode where we are going to be covering how to understand market control, who's in control, supply or demand, how to understand changes of character, and then finally, what criteria makes for a high quality zone. I'll see you guys in the next one.